The global economy continues to improve thanks to recovery in labor markets in several industrial countries. So domestic demands continue to be strong, and it's a good aspect for the future. Investment also will continue to recover next year for sure. However, better growth means less accommodative monetary and fiscal policies. In the US, the Trump administration is discussing currently with the Congress for a fiscal reform. We don't know exactly what will be delivered by the Trump administration, but the market's anticipations are extremely low right now. Concerning the monetary policy in the US, the Fed started to normalize its monetary policy. There is a big question about December. Will they decide to increase interest rates in December or not? It's open to discussion because the Fed changed a little the way they communicate to the market. We continue to expect 3 hikes by 25 bips next year. The Fed will continue to normalize its monetary policy. The ECB will not change its monetary policy. It will stay very accommodative, no increase in rates. However, they will probably diminish their quantitative easing as soon as next year. We turn neutral on oil prices because the oil price reached our target, $55 a barrel, at the end of September. So we think that the potential for the next move is not high enough to continue to be positive. We turn neutral also because we believe that above $60 a barrel, US production of shale oil and gas will increase sharply, and the discipline within OPEC could diminish. On the downside, we don't think the risk is too high also because structural demand is robust, especially coming from emerging economies. So we stick to the neutral view, and we expect not a big move, nor to the upside, nor to the downside concerning oil prices. This is the reason why we don't change our recommendation on oil sector listed on stock markets, because we believe that if we are right on oil prices, the cash flows, the future cash flows of those companies will continue to improve, and they are late compared to the rest of the market. So we stick to the positive view about the oil companies on the stock markets. Stock market need to pause if they want to be able to continue to rise for the long run. For the long run, we are still optimistic. Economic growth is there, it's improving, so the cash flows from listed companies will continue to increase, and we don't have a doubt about double-digit earnings for this year and next concerning the major stock markets. For the long run, there is no alternative than to buy risk, to continue to buy equities. Interest rates are too low. However, for the short term, we think that there are some reasons to be a little more cautious and to expect this pause. First of all, economic leading indicators are peaking, so they are stabilizing at a high level, and we know it's quite important for stock market. Secondly, technical indicators are beginning to deteriorate concerning stock markets, and especially concerning the US market. Thirdly, political risk could make a comeback. First, we have this question about the US fiscal plan. Will the Trump administration be able to deliver this time or not? It's a very important question for the short term. Secondly, in Europe, the Catalonia question is still there, and we don't see a rapid solution for the moment. And in the future, the political risk in the Eurozone will come back as we have this Italian election to come in the beginning of next year. In conclusion, we are still positive for stock market and for risky assets in general for the future, but we expect short-term a consolidation. Thank you for your attention.